All right, chapter 5, purchase transactions. All right, so the rules are different if you're a seller versus a buyer. That's why we have got the buyer's hat on. And when you're doing these problems, that's the first question you want to ask yourself. Am I a seller or am I a buyer? Because it makes it, the rules are completely different. All right, so here's the rules if you're a buyer. Oh, by the way, we have our merchandise inventory account. What kind of an account is merchandise inventory? Asset. Can anybody tell me under the, when we're buying things, what increases merchandise inventory? Purchases and freight. What decreases it? Purchase, returns and allowances, and purchase discount. They decrease, these increase. All right. Under the perpetual method, do we ever use these words? No. The only word we use is merchandise inventory when we're journalizing. So we use these words, we use merchandise inventory to debit to increase the account and credit to decrease the account under these four scenarios. All right. So, we're purchasing something. Do we call purchases? No. We debit merchandise inventory. And looks like we bought it for cash because we're shelling out cash at the same time. Are there two journal entries under the buyer's hat? The answer is no. So on the buyer's side, it's a lot easier because you don't have to worry about your cost of goods sold and your depletion of inventory because the buyer is just buying something and putting it into their inventory. Here we bought it on account, created a liability. The buyer may receive a discount from the seller for early payments, so we're going to call that a purchase discount. The seller is offering us a discount. Right? So basically on our side with the buyer, it's a purchase discount, not a seller discount. And what are they doing on this slide? Oh, okay. We're determining whether to take the discount or not. All right. So the guy offered us a 2% discount on $3,000 if we pay in 10 days, but we don't have the $3,000. So they're saying, hey, should we go out and borrow the money? And so the discount is $60. You go to your banker and say, I want to borrow X amount of dollars at 6% for 20 days. What's it going to cost me? Banker says it's going to cost you $10. So in this case, would you take the discount? $50. Savings from borrowing, right? You save $50 by you can go out and borrow. So you say to yourself, well, $50 isn't much. Why would I go do all that? Well, what if this was $3 million? All right, you didn't have $3 million laying around. You wanted to go out and borrow it. All right, so your savings would be comparably $500,000, right, for taking that discount. That situation, I can save myself $500,000. Let's go out and borrow that money for a short period of time, and then take the discount. So that's all they're just saying there. Is you might, and 99.9% of the time, unless this is really, really, really high, you're going to save money by taking the discount. So all they're just saying is if you don't have the money laying around, you might want to think about going and borrowing it on a short-term basis. That's why it's good to have a friendly banker in your back pocket, right? You either have a line of credit set up. Most businesses have a line of credit set up, so where you can go out and just do it on a short-term basis. That's all they're saying. All right. What are we doing here? We issued an invoice for $3,000 in net solutions, terms of $210 net 30. Based on the calculation of the previous slide, we're going to pay the amount due, less the discount on March 22nd. 12th, 22nd, we're paying within the 10-day period. All right, so again, buyer, what are we going to do? Here's what the buyer is going to do. Buyer's books. The $3,000 that we owe goes away with a debit to our accounts payable. We're going to send a check for $29.40. All right, so our cash goes away. And what do we do when we recognize a discount that the seller is offering us? Do we call it that? Do we call it discounts? No. What do? We credit merchandise inventory. So the seller opens up the mail and there's a check there. Says, and there's a check there for $29.40. He goes, hey, wait a minute, that guy bought $3,000 worth of stuff. Oh, that's right, I offered him a discount. He's taking advantage of the discount, so he's sending me a check for $29.40. Right? But this is what the buyer is going to show on the buyer's books. Remember when we did the seller, it was completely different. So that's the confusing part of this chapter, whether you're a buyer or a seller. What would we do on our books if we didn't take the discount? Well, it's just real simple. We get rid of the liability, we shell out $3,000 worth of cash. What if we return stuff? All right. Purchase returns and allowances is what we're verbally going to call it, but we're not going to journalize that. We're just basically saying, hey, we're sending, with a debit memo, we're sending notice to the seller that, hey, we're going to send some stuff back to you. What we're sending back to you is $900 of what we bought. Right? So what do? Well, we don't owe this amount anymore, and we don't have it in inventory, so that's an asset decreasing and liability decreasing. And so we bought $5,000 worth of product, $210 net 30. We sent $3,000 back. So how much do we owe now? We bought 5, we sent 3 back, we owe 2, right? So what are we going to take the discount on? We're going to take the discount on what we owe. So 2,000 times the 2%, that's going to give us our discount of $40. We're going to send the seller a check for $1,960, and we're going to take the $2,000 that we owe off the books when we pay this bill. Buyer's hat, buyer's journal entry. All right, go to practice exercise 5-3A. See if we can handle any of this.